Did you know that it's really easy to pick the right stocks? Well, it's not. Warren Buffett actually made $1 million bet against a hedge fund to prove this. He picked the S&P 500 while the hedge fund did all their stock picking, and they ran the bet for 10 years. After 10 years, the hedge fund's return is 36%. Not too shabby, right? Well, Warren Buffett's S&P 500 index gave 125% return. Turns out 90% of stock pickers, money managers, and hedge fund can't outperform the S&P 500. But of course, you're not here for that generic answers. So let's talk about how we can invest like the super investors. Super investors, specifically all investment managers with at least $100 million in asset under management, are required to disclose their investments publicly. We call this 13F filing. This means that retail investors like us are able to see where Warren Buffett, Charlie Munger, Monish Pabrai, Terry Smith, and other super investors invest their money. So what can we do with this information? To start, there are more than 50,000 publicly traded companies. So us mere mortals don't have the resources and time to identify, study, and value them. It's physically impossible. So one shortcut to minimize this huge amount of companies is to create a high-quality list of companies by copying the super investors. Monish Pabrai put this really wonderful.
That cuts down the data set dramatically. And not only does it cut down the data set dramatically, it gives you a great pool to look at because it's already been through one filter by a great mind.
So I can just go and copy these super investors? Well, not really. You still need to do your own research and analysis. We can't just buy a company just because somebody recommended or bought it. Like Warren Buffett said, you can't just buy what's popular and do well. What we can do is copying what's in the super investor's portfolio and create a high quality list of companies. One of the sites that I use is called Dataroma. There, you can see the list of super investors and their portfolio. But before we start picking stocks, we must understand the pros and cons of this strategy. Starting with the risk that copying and cloning does not guarantee success. There is no 100% winning strategy when it comes to investing. Super investors investing in these companies does not guarantee that the company will perform better. It just means that the super investors sees a profitable opportunity in these companies. We are also working with delayed information. There's a lag before other investors see these 13F filings from institutional investors. But Ron, you said they're required to disclose their investment. Yes, they are required to show and disclose their investment to the public, but they are allowed to have a lag of 45 days. This means that the information that we are getting are delayed information. The stock may have already moved significantly between the time that it was bought or sold before we even get a hold of this information. So keep in mind that this information is delayed or late, whichever you prefer. One such example and effect of super investors' moves is called the Warren Buffett effect. This is when Warren Buffett, the CEO of Berkshire Hathaway, can move a stock unintentionally just by buying and selling his position. Due to how successful Warren Buffett is, when he announced that Berkshire Hathaway has bought or sold something, many investors will go out and do the exact same thing. So if you're late to the party, you may be buying or selling at the worst time. Alternatively, you can always invest in Berkshire Hathaway. For full disclosure, I own some Berkshire Hathaway shares, not the expensive one, but the cheap one, and I'm consistently increasing it. And since we're here on my portfolio, I'd like to share my dividends for the month of December. Last December 15, Coke, Home Depot, Realty Income, and Stag Industrial paid me $15, $11, $9, and $6 of dividends. SCHD, Target, and Microsoft also paid me $12, $14, and $13. Johnson & Johnson, Pfizer, and Kroger also paid me $16, $17, and $11, with a total value of $127 of dividends. This is actually the highest dividends I received since I started investing, and I reinvest these dividends back to my portfolio, which will increase the number of my shares, which will increase my future dividends. Some of the companies on my portfolio are actually inspired by some super investors. If you're getting value in this video, feel free to hit the like button. It would show that what we're doing here is really helping other investors. And don't forget to subscribe to get more videos like this. But of course, cloning right then and there is never a good idea. Do not assume that copying or cloning trades and investments from the best super investors remove the responsibility to do your own due diligence. Here are some checklists that you might want to look at as a bare minimum. Check the company's historical data. And no, I'm not talking about historical price data. I'm talking about revenue, profit, operating income, shares outstanding, historical cash flow, and debt. Understand What is the company's business? What do they sell? Who's the customer and who's the competitor? Is the product and services that they offer in high demand and not easily replicable? And remember that these are not financial advice. Please do your own research and make sure to talk to your own financial advisor before investing your money. Make sure that the stock you're considering is suitable for your investment objectives and especially your risk tolerance before investing in it. If a stock has already moved up on news that super investors have taken position, the best course of action is maybe to wait for it to come back within your buying range. Eventually, the stock will revert back to its mean, and if it doesn't, you can always buy something else. You can check all these super investors' investments and make a list of stocks that you might want to consider looking at and investing in. Clone or copy investing has its risks, but following successful investors, having strong and consistent patience, and making sure to do your own diligence can help you increase your investment success. Of course, after buying a stock, there are things and steps that you might want to consider to make your purchase and investment more profitable. We don't just wait until it's 2 cents or $5 higher. In fact, more money is created without selling. And in this video, we talked about what should we do next after buying a stock.